What's up, guys? Welcome back to the channel. I'm Mike. If this is your first time to the channel, hit the subscribe button to grow your wealth, increase your success, put you on the road to financial freedom. And while you're at it, smash the like button to help this channel and this video in YouTube. Today we're going to talk about a way to easily double your money using the stock market. All right, guys, there is an easy way to double your money in the markets. It's a pretty well-known rule of thumb that about every 7 years, on average, you can double your money that you put in an account. And that is because there is approximately a 10% return annually in the S&P, including value and dividends. And so if you multiply that out, like for example, on a calculator, you take 1, you multiply that by 1.1 for a 10% gain, and you do that 7 times, you'll end up with, it'll be just under double, so it'll be just under 2, but you end up with like 1.95 or something like that. So about every 7 years, and you know, at 10%, it's a little bit longer than 7 years, the money that you put in an account will double without you doing anything at all other than waiting. So how do you go about taking advantage of this 7-year rule? What I would do is I would, as I say all the time, invest in S&P 500 index funds that track the S&P 500, or funds similar to that. For example, for a total market fund that is every equity in the, for example, the US market, but that would also include all of the ones listed in the S&P 500, which makes up the 500 largest companies in the United States. So when you put your money in those funds, it will, and you leave it there, it will automatically be subject to the 7 or 8% valuation and the 2 to 3% dividend return of S&P 500 stocks over time. So all you need to do to take advantage of this is to take action and put some money into a market account and then leave it there for an extended period of time. And that's really all it takes, is just time and discipline not to take that money out of the account and just let it work its magic for 7 years. And the thing to think about this as well is, once you put that first amount of money in, and then if you are dollar cost averaging on purpose, or if you are just putting money into accounts as you get paid, each time you put a new dollar in there, that has essentially a start date for its doubling time is 7 years. So as you get down the line, when your first dollar that you put in comes up to its 7-year mark and it's doubled, you're going to have potentially tens of thousands, hundreds of thousands, however much money you put into there, coming up on their 7-year mark to when they double. And then if you leave them there, it's not like at 7 years, it's like double done. If you leave them there, they'll just continue to, increase in value, and they'll double again over the next 7 years. And you can see how that compounding doubling could go on to lead to a gigantic amount of money from just a small amount of initial contribution. But there's some things to watch out for that could negatively impact doubling your money over 7 years in the markets. And one of the big things is high costs. If you put your money into high cost funds that are charging you, 1 or 2%, that dramatically changes the length of time it'll take for your money to double. So when you do the math on the higher fee accounts, for about every 1% that you are paying to whoever to manage the higher fee accounts of like 1 or 2%, you end up needing another year to double your money. So for example, if you pay 1%, which reduces your total return to 9% annually, it takes you 8 years to double your money. And if you pay 2% total to take your return down to 8% per year, it takes you 9 years to double your money. So the key is just to keep your costs as low as possible, to keep on that 10% return for doubling your money every 7 years. To keep your costs low, I always recommend low-cost index funds. Vanguard has several that have a 0.04% expense ratio, which is essentially not even worth calculating for your total return. I keep most of mine in VTSAX, which tracks the entire US stock market. I know that Fidelity also has some low and zero cost funds that would be worth looking into, as well as I'm sure other financial firms offer low and perhaps no cost funds. In addition, market volatility can and will happen. There will always be something going on in the world that makes the markets either go way up or way down. It's easy to stay in when they're going way up. It's a lot harder to stay in when you look at your account and you've lost 10% that day and causing panic selling and locking in losses. The key to take away here is that 10% returns are a historical average, and you need to leave your money in the market over time and avoid panic selling in order to see the doubling of your money in 7 years approximately. And then again, if you just intentionally sell early, even when the market's going up, obviously that's your prerogative. But if you sell at year 4, you're not going to double your money in 7 years, obviously, because you've taken it out. So again, the longer that you leave your money in, the better the results are going to be. The last thing I wanted to say is that the 7-year rule on doubling is typical results. You may end up hitting a time where it's just there's bad economic news for 3, 4, 5 years, and you don't get the 10% returns. However, you're more than likely, if you hit a year or two of negative or flatter returns, that over that 7-year period there will be some sort of recovery that ends up being greater than 10%. But just keep in mind that the 7-year doubling of money is under typical market conditions that have been observed in history and don't necessarily mean that they will do that going forward. However, there's over 100 years worth of evidence there, so I feel pretty good that we will continue on about a 10% return. So there you have it, guys. Put your money in an account, leave it there for 10 years, make sure that you're not being charged ridiculous fees and you're not selling on any type of market volatility or pulling that money out early to buy some new shiny object that's not going to be worth anything in 7 years. If you do all those things, you can double your money in the market in 7 years, approximately. So if you guys found this video helpful, you liked it, hit the like button. Make sure to subscribe to the channel so you don't miss any of my future videos. And thanks for watching. I'll see you next time.